Welcome everyone, and thank you for joining us for today's webinar entitled Assuring Revenue Recognition Implementation Success. Although the new revenue recognition standard doesn't take effect for many companies until 2018, companies shouldn't wait until the end of the year. Public companies in particular have less than 8 months to prepare. In order to comply, companies will likely need to update systems, processes, and controls, leaving companies with a lot of work ahead to get their systems ready. Many will struggle to adopt on time. In order to assure a successful implementation, today's panelists will be discussing best practices, including lessons learned from early adopters who have started ASC 606 and IFRS 15 preparations, major complexities that companies may face when adopting the new standard, and the importance of compliance and suggested next steps for timely and effective transition. Today's 1-hour session will be offering 1 CPE credit for attendees. There will be 4 polls through the course of this webinar, and attendees seeking CPE credit will be required to answer 3 out of the 4 polls. An evaluation survey will be emailed to all attendees after the webinar. If you have any questions, feel free to type them in the Q&A module. At this time, I'm excited to introduce to you today's moderator, Jeff Halden of SOFTRAX. Jeff is located in the Bay Area. He is a CPA, and before joining SOFTRAX, he worked with EY and Capgemini. I'll now turn it over to Jeff, who will be introducing today's panelists.
Great, thank you, Julia. Hi, everybody. Welcome. Thanks for joining our panel discussion of the new revenue guidance for revenue contracts with customers. We have an amazing panelist, a wealth of experience and expertise today. Let me do a quick introduction. First off, Tony Sondhi. Tony's a member of the EITF, has a long history with ASC 606 and all the related guidance elements, in fact. He advises companies, he leads training seminars, webinars, also gathers a lot of information from the market on the issues, and we'll have Tony comment on that in a moment as well. So welcome, Tony.
Thank you, Jeff. Glad to be here.
Also, Shauna, yeah, great. Shauna Watson. Shauna leads RGP's finance and accounting practice, including the RevRec and the leases guidance initiatives. Shauna has a Big Four audit background, a lot of industry experience, and is also a frequent speaker on the topic. So thank you, Shauna, for joining us today.
Thank you.
And also Paul Schumacher, and Paul has spent over 25 years in the accounting profession as an auditor, in company management, and most recently as a regulator serving the public interest. He just last week became a former PCAOB Associate Director, where he led the U.S. Risk Analysis Program in the Office of Research and Analysis. And also there as an inspector in the Division of Registration and Inspections. Paul also worked in industry, has a Big Four background as well. So welcome, Paul, and thank you all for your time today.
Thanks, Jeff.
So we're going to jump into our first poll sort of on the topic of lessons learned, or maybe lessons learning still, and wanted to first get all of our attendees' input on what best describes really where you are currently in the process. This is a select one poll, so either not started, assessing, implementing, or perhaps just panicking. So go ahead and respond to that poll, and we'll take a minute to let that compile. And Paul, while we're waiting for the responses, maybe from your vantage point, knowing your background with the PCAOB, I mean, where do you see the companies are at, and, you know, are they at risk in meeting deadlines?
Thanks, Jeff. Well, hopefully not too many folks are panicking.
I have some free time on my hands right now, so I thought I'd do a little bit of analysis to see where companies stand with their 606 implementations. So using my CalcBench tool, I looked at the SAB 74 disclosures from the first quarter 2017 filings of the Russell 1000 companies with fiscal year ends after December 15th. I'm about a third of the way through my analysis now, and so here's what I found. About 60% are still in the assessment phase, and about 40% of those 60% initially believe the adoption won't have a material impact, but they're still assessing. Some of them say they're waiting on decisions by peer group task forces. About half don't expect the impact of the adoption will be material, but as I said earlier, many of those companies are still assessing to make sure. 35% are undecided whether the impact will be material, and 15% talk about issues they have identified which could be material. The IT and industrial sectors have the most in this category. 11% expect to, or are, because there are some early adopters, using the full retrospective transition method of adoption, and 51% expect to use the modified transition method. 37% are undecided about their transition method.
Okay, great. Thank you, Paul. Let's go ahead, Julia, and get the results from what we're seeing here today. And it looks like we have 54% out of our group today assessing, a quarter implementing, which is good, and only 3%, so not too many, as you noted, Paul, in the panic mode. I guess we could have people both panicking and implementing, and we didn't have that option here. So, Tony, I know that you survey the market regularly as well, and get a lot of feedback, and I know I had the pleasure of listening to an event that you were on just yesterday. Maybe you can comment. Well, I think we have some information we can display here, Julia, and let Tony cover what he's been able to discern.
Thanks, Jeff. Yes, I have actually been surveying the market since July of 2014 during my monthly webcasts, which we do normally on the third Tuesday of the month, but sometimes the third Tuesday actually falls on a Wednesday, and so we end up doing those on Wednesdays. Anyway, what I've been finding, as you can see, starting from 2014 on your screens, where not started assessing, which to me, the way I've always explained it to my audiences, is that, where you've started looking at it, you're reading, you're going through training or something, but you haven't really started looking at how it's going to affect your company. You may have done a little bit of it, which, as you can see, started at about 61% in July 2014, and as of April, that last column should only say April, sorry about that. And so as you can see, in April it was 20%. In the poll that I did yesterday in my webcast, it was down to 15%, as you can see here. And then if you go back to the previous slide, I'll just talk a little bit about some of the other sections or other responses. So for example, the initial read and preliminary assessment, where people are part of the way into it, that we had gone, it stayed sort of stable, it looks like here, from 39 to about 41%. The formal assessment, where you're certainly into it, you've started looking at your business units, you've started developing some position papers and so on, that we had actually reached 19%. And then transition, major decisions completed or fairly close to being completed, we were at 16% in April. And then where you're way ahead of the game, that, as you can see, is around 3%. And it's interesting, that hasn't changed a great deal, but that's where we are. Now let's take a look at what happened yesterday. And if we can go to the next slide, I'll just make a few quick comments on that. Then we'll get on with the rest of it. So you can see some interesting changes, 15% for not started. The initial read is at 41. We've got about 22% through the formal assessment. The transition major decisions are 20%, and approvals are around 3. I do want to point out that these are monthly polls, and this one yesterday, was also one of those. We do get, somewhat different audiences, and one of the things, as Paul, I think, is going to talk about a little bit more later on, and I'll add to it as well, you have to be careful because not all the people in the polls are decision makers, and while we certainly think they have a good basis for responding, they may or may not be able to convince the executives who make the decisions, such as CFOs and so on. So we have a sort of a mix in the audiences, and you have to sort of keep that in mind. Remember, Paul pointed out that some people had said they were going to do this. They were thinking of it going in a certain direction, but they're now reassessing, that sort of thing. So that hopefully gives you a sense of where people are. I too was glad to see that only 11 or 12 people in our audience are panicking.
Thank you, Tony. And so with your numbers there and our poll today that showed 25% implementing, I want to go to Shauna. It would seem at this point in the game that maybe we'd have a higher percentage having figured it out at least well into implementation mode. I'm curious, then, Shauna, on your thoughts on, have companies overlooked the level of effort, or, it's just much bigger than people expected? I mean, what are you finding from your client base?
Well, I think the interesting thing to find out from those people that answered panicking would be whether they're panicking because they haven't started or panicking because they have started and realized that there's more work to do than they initially thought. We are finding that particularly for companies who kind of expected it to be an immaterial impact, and they may actually end up having an immaterial impact to the balance sheet and income statement, the disclosures will likely be impacted, and it is probably worthy to note that the SEC does not view the impact to be immaterial if your disclosures are impacted. So I think we might be seeing some differences in that 50% that are saying that it's going to be immaterial based on that SEC speech a couple weeks ago. But the problem companies are having and finding is the documentation takes a long time. Of course, the analysis to get to the right answer, because there is a lot more interpretation and thought involved. But the documentation can be really difficult to do. You have to maybe come to the same conclusions, but you still have to get there in a different manner. So documenting the white papers and the policies and monitoring and changing your internal controls, it all takes a lot of time. And even with business going on as normal, unless you have a dedicated team, getting the decisions made on the policies can take some time and lead to delays.
Yeah, great. Thank you, Shauna. And knowing that it is such a big effort, I'm curious, Paul. I mean, in my discussions with a lot of companies, they're a little bit put off, I think, by what they're getting out of their public auditors, which in some respects is understandable. But what do you think? What should the auditors be doing to assist their clients in the transition? Or is that even the right avenue to rely on for assistance?
Well, Jeff, assistance can take many forms. I think one way auditors can assist is they can get started now. I mean, when I was an auditor, I don't think I ever got started a year early on an audit, but the size of this implementation, there are so many things they can be doing now to get started. Open up lines of communication between the management teams, audit committees. But also you have assistance in terms of, giving advice. And I guess the question becomes, when does giving advice, providing research materials, and making editorial comments cross a boundary and resemble procedures that could impair an auditor's independence, such as making policy elections, accounting decisions, bookkeeping, and rewriting footnotes? There are dozens of PCAOB and SEC staff speeches related to independence over the last several years. too many to start quoting. There are PCAOB and SEC enforcement cases, recent ones and old ones, specifically related to bookkeeping, loaning staff, management rep letters not agreeing to procedures or results of procedures actually performed. In his remarks before the 2016 AICPA Banking Conference, Wes Bricker, Chief Accountant of the United States Securities and Exchange Commission, talked about independence as it relates to new accounting pronouncements and auditor assistance. In the interest of time, I'm only going to read a few key phrases, but please do read the full section on your own. Although the speech was actually related to the adoption of another standard, the context is still applicable. So Wes stated, auditors can still be helpful as long as they are mindful of the independence rules. Where management makes its own informal decisions regarding how applicable accounting principles apply to its company's circumstances, the auditor may discuss freely with management the meaning and significance of those principles. As long as management, and not the auditor, makes the final determination based on its own analysis as to the accounting used, including determination of estimates and assumptions, and the auditor does not design or implement accounting policies, such auditor involvement as an input to management's process can be appropriate. So I don't think it's any secret that revenue recognition and the internal control environment around revenue recognition can be very complex. For some companies, the number of decisions to be made in the implementation process will be significant, in the hundreds, if not thousands. If I represented management, I would feel comfortable picking up the phone and talking to my auditor about the meaning of terms like simple procurement service or the word significant when evaluating a significant service of integrating goods and services, or holdbacks on milestone payments and whether a significant financing component exists. The process for performing an assessment and developing and approving the new revenue recognition policy would include controls evidencing approval, perhaps by a RevRec approval committee, of the final determination of policy based on our own analysis, management's analysis, as to the accounting used. When it comes to the implementation and potentially reviewing hundreds of contracts and evaluating potentially thousands of non-standard terms and making decisions, I'd want to make sure any assistance provided by my auditor was really in that category of input to management's process, as Wes Bricker stated. Key controls could not be designed or implemented by the auditor assistance, and final determination of decisions would be based on our own analysis, management's analysis. This relates to key controls around all relevant management assertions. Situational facts and circumstances are generally unique as they relate to independence. If the auditor has independence concerns related to procedures performed by management teams or non-engagement team members, then consult. Many audit firms have dedicated persons to address independence questions. For smaller firms, or questions that in-house ethics and independence personnel can't answer, the regulatory agencies, the SEC, the AICPA, the PCAOB, and other regulatory bodies may be able to provide help.
Okay, great. Thank you, Paul. And I know Tony and Shauna, you're both going to have some advice for people. Maybe we'll come back to that at the end, perhaps in our closing remarks on how, companies can best move forward if they do need more help. Let's move on to the next poll question regarding actual technical accounting issues and what are the real challenges with the new guidance. So participants, if you would, this is a select all that you like, and as you can see, they're fairly high-level topics, but maybe you can, work through that. And while we're waiting to get those poll results, Tony, I want to maybe jump to you and get your thoughts on, what you're seeing and hearing in the market. What are companies really struggling with related to sort of, new elements of the guidance that are, new initiatives for companies to adopt.
Okay, I think, thanks for that. And let me begin by adding to something that Shauna pointed out so well, and that she was talking about the documentation complexity and the need for that at the implementation. What I also think you should consider, which I think was implied in what she was saying, is that documentation is a big deal in this standard. It's different from what we had before. So even if, as she said, you're doing the same thing, keep in mind the documentation is critical. So I think when you combine the documentation need with some of the other critical changes, you find that this is a fairly complex standard in some ways. It's still doable. It's not as if one should be panicking or anything, but the point is that it's a fair amount of work, and you need to keep that in mind. In terms of what people are finding problems with, just about everybody, I think, is concerned about the capitalization of costs, simply because we haven't been doing that. And that's because neither the FASB nor the EITF has done a good job of providing any guidance in there. Every time we've been asked, we've always said, well, it's too big a problem, we'll figure it out some other time. So this is the first time that we did something worthwhile with it at the board. So in that sense, I think it's very important. The second thing is that even for cloud companies who have been capitalizing commissions, they're finding that the customer relationship term issue is an important one. After that, I think probably the most important issue that people are facing is the variable consideration. And along with variable consideration is the general difficulty of developing estimates. You need historical evidence. You may or may not have been doing that. The kind of evidence that you need, the complexity of the computations, these are things that I think people are finding a great deal of difficulty with. Another area is for companies that have large numbers of contracts. This accounting standard in some ways can be very difficult. In some ways you have the portfolio, practical expedient, you have a few other choices, the series definition that they're using in 606. So if you are careful, you can actually mitigate or even eliminate some of the complexity. But it is going to take a fair amount of work. And the final point I would make is that in order to make it possible to do and to meet some of the technical challenges, I think it's time people started thinking about having software and really improving on their IT systems to do this. But we're going to talk more about that later on.
Okay, great. Thank you, Tony. So the poll results are up, and as you can see, there's a fair number that are having multiple issues, would be my assumption as I first look at that. Shauna, what does this mean? What do you reflect? How do you reflect on this? And what are you seeing in your client base as far as challenges in preparing for adoption?
Well, I think from a technical standpoint, really it's everything. Everything can be a challenge, and the issue that is most important is your issue, whichever one you're having problems with at your particular company. So it doesn't even matter what other companies in your industry are having problems with, but the one that you're having the issue with, that's the one that's drawing all the attention. So that might be capitalization of costs, commissions, it could be your disclosures, it could be estimating the variable consideration, coming up with a standalone selling price, and whether you're able to use the residual approach. All those things can be a big challenge, and the guidance is specifically vague, and you can come to different conclusions with similar but not the same circumstances. We're also seeing some differing opinions at the audit firms, and the discussions continue ongoing. There's some ongoing documentation and consideration activities at the AICPA that we'll talk about in a few minutes. But I think the most challenging part is trying to figure out whether your circumstances and facts, how closely they mirror the judgments that have already been made through the TRG and the FASB ASUs. And then, of course, wondering whether you're going to be second-guessed by your auditors, by the SEC, and the PCAOB. But the SEC has made it pretty clear that if you do a reasonable job of analyzing the standard, supporting it in GAAP, and coming to reasonable conclusions, that you will not be second-guessed. So they are seeing an increase, I think, in the consultation and pre-clearance activity. It sounds like their companies are coming forward quite a bit more, and perhaps that's the reason, is just because of the new frontier that we're kind of experiencing here.
Okay, great, thank you. And Tony, curious then, as you've been out, compiling results and talking to people working with companies, how big is the disclosure impact? How big of a hurdle is that for most companies, knowing that there's much more there to disclose, in the financials?
There's no question, that's correct, that the disclosure requirements have changed. In fact, for many companies, the types of disclosures that they'll have to provide, they'll probably be doing so for the first time. So they have that issue. The other aspect that I think is really critical about disclosures is that 985-605, which is the current software standard, that really doesn't have much, if anything, in terms of disclosure requirements. So for many software companies, the type of information that's required, the level of disaggregation that's required, all of that is going to be fairly significant. Now, for cloud computing companies, they ended up with some disclosures that they've added as a result of the multiple element literature. But again, the types of disclosures needed are tricky. For many of the cloud companies and many others as well, there's a question about the type of information that you have to provide about your revenue, about the deferred revenue, and given, depending on how you've been defining backlog or what you think backlog is, there are some additional requirements there as well. But please be careful, and I want to be very clear, and I've told my clients this, that they should take a careful look at the way the FASB talks about this. And they're telling you very clearly that we're asking you about deferred revenue, we're asking you about your performance obligations, those that are partially satisfied, not yet, and all that kind of stuff. But they also make it very clear that the SEC has certain regs about backlog. Those definitions should be understood. So my recommendation is read the basis for conclusions on the issue of some of these disclosures before you decide to go ahead and panic about what's required.
Okay, great. I'm going to try to incorporate a question that came in from one of our participants. You had mentioned, Tony, cost capitalization. We know that it's obviously new. The question is, I don't understand how capitalization of cost is an issue. It seems pretty straightforward. And I know that there is a fair amount of complexity, both in then how those costs for certain industries might have to be amortized, and wonder if you could maybe comment on if you've seen, as companies prepare for that, what they're viewing as the complexity of that new guidance element.
Okay. Let's begin with the incremental cost of obtaining a contract. If you carefully read and understand that definition, then you will see, for example, that commissions are probably the best example of incremental cost of obtaining a contract. But then you have to worry about, for example, what is the formula used to determine the amount of the commission? Does it depend, can you attach it directly to the contract? Or does it have some other components and variables in its formula? Another question that some companies have is what to do about fringe benefits that may increase as a result of commissions. Then the other thing which you have to be careful about, for example, if you're a cloud company and you've made an accounting policy election the last few years to capitalize your commissions, you may have been doing that over the contract term. But now you have to think about whether you need to do it over the customer relationship term. And for that, the Transition Resource Group discussions of the FASB staff papers on inquiries that have been submitted to the board on commissions and cost capitalization are critical. The next component is the cost to fulfill a contract. Now that is new. And there are two aspects to it that you have to be concerned about. For example, one is that you only apply the new guidance in ASC 340-40 to cost to fulfill a contract that are not already covered by other guidance, such as the accounting guidance on inventories, property, plant, and equipment, internal use software, software that you intend to sell, lease, or otherwise market, certain kinds of pre-production costs in long-term supply contracts. So the point is that you have to be very careful with cost to fulfill a contract. And what makes it even more complex there is that you probably don't have records of it. We normally don't find companies keeping as extensive a record of a cost that has to be expensed as they would of a cost that has to be capitalized, because there you have to think about a lot of different variables. For software companies, on-prem and cloud, they're going to have to worry about their R&D costs to some extent as well. I know they've been doing internal use software or cost, 985.20, but now the question is, how does that change, if at all? And so in that sense, even though it might be straightforward at first blush, there are complexities in it that you have to be careful about.
Okay, great. Thank you, Tony. Paul, knowing that you've had a preview of sorts in your role at the PCAOB, I wonder if you could comment on, what you're seeing and starting to compile related to the SAP 74 disclosures and, the approach maybe that companies are taking in those initial disclosures.
Well, I can't comment on what I saw when I was at the PCAOB. I have an NDA, but what I've done since I was at the PCAOB, I've looked at a little over 200 companies, and about 20% of those are saying that they have material items. I'm seeing, cloud-based companies that some of them are, recording revenues earlier. Some of them that appear to have similar facts and circumstances are actually not recording the license revenue earlier. So I'm seeing a little bit of diversity in practice. I've looked at some of the early adopters, and I've seen amortization periods that are of capitalized commissions that are doubling year over year, which kind of makes you scratch your head a little bit. I would have thought that would have been smooth. So it's, I think it's too soon to tell. There are so few companies that are, coming out and saying what their differences are. I think as we progress and the second quarter is filed and the SAB 74 disclosures evolve, a lot of the companies I've seen have said, hey, we're not saying anything right now. We're going to say something in Q2. I've seen a couple companies say they're going to say something in Q3, which I think, is that going to give you time to finish? But I think we'll see the SAB 74 disclosures evolve. You'll see a lot more information in those, and companies will be able to take their peers and, line them up and say, okay, here are what all my peers are saying, and here's what they're doing. So I think there will be a lot of good information that you can get out of the SAB 74 disclosures.
Okay, great. Thank you. Let's move to the next section with another polling question. And for our participants on the webinar today, what are you seeing now as the biggest challenges with implementation? Maybe those of you that are either in it or striving, planning for it. And this is another select all that apply: updating systems processes, training and communications, program and resource management. Maybe while we're waiting for those poll results, Sean, I know this is an area that you guys really do a lot of work in, advising clients, helping clients work through these implementation planning and execution efforts. Curious what you're hearing and seeing with your clients regarding implementation challenges.
Well, aside from the technical interpretations that we talked about, some of the challenge is the timing and the fact that, as I mentioned earlier, everybody has other work going on, implementing ERP systems or acquiring or divesting businesses. There's a lot of stuff happening that is drawing the attention away from the people who are internally responsible for implementing this, even the quarterly and annual reporting, to focus on this particular project. From a systems perspective, I do think if you're having a material impact to your accounting policies and needing a new system, the systems are proving somewhat difficult. I mean, very important, of course, to define your requirements before you select a system, but then going through that process and then the configuration and integration. How much effort that is, of course, depends on the company size, how much impact you have, the extent of decentralization, and how many legacy systems you have, et cetera. And then even determining your transition method, doing a thoughtful analysis of whether the full retrospective with the restatement or the modified retrospective is going to be favorable and preferable for your company. I think that can take some time as well.
Okay, great, thank you. And it looks like we've got the results in. We're showing a good majority challenged with systems and processes, more so than managing the project and communicating it internally, which isn't surprising. But you know, we know that there's a lot of complexity that the new systems, whether it's your internal ERP or you're looking for new support, a lot of complexity that needs to be accounted for. So Tony, as we think about some of that complexity, you know, maybe the interest element, you know, time value of money, some of the things that are a little bit harder to, you know, to implement and to incorporate into your current systems, there's a lot of complexity in managing revenue. So any thoughts on how companies can best adopt the technology, or are we going to see a lot of Excel and all the control issues surrounding that?
Well, as you know, there are unfortunately lots of companies still using Excel, and if you think about what we've said and what the other panelists have said today about documentation, about internal controls, then you know that there are too many problems presented by Excel. And when you add on to that the documentation, the variable consideration, the estimates, those all make it even more imperative that you do something about doing something about your IT systems. The time value of money is a very, very big thing, because previously, or today I should say, in current GAAP, we only have extended payment terms. And that's only for when the customer gets additional time to pay. Now what you have to do is keep in mind that the significant financing applies to both cases where payments are received in advance and payments are received later. Of course, there is still a very important consideration that if the time difference between performance and payment is due to reasons other than financing, then you wouldn't be recognizing financing. But otherwise, you have to. So that makes it very, very important to keep in mind. The other thing is that the computation, the interest rates that you use and the way you apply them is fairly complex. So from that perspective, I think significant financing is certainly one of the more important issues. And in your IT systems, you need that capability. And as you know, I've worked with SOFTRAX to develop that feature with respect to the time value of money. So I think you need to be very, very careful. The analysis is complex. The underlying rationale has to be documented carefully. And then when you do have significant financing, you have to be very careful about the computation.
Okay, great. Thank you, Tony. And Paul, thinking about the impact of maybe being an outlier, which of course is a concern for most companies. I mean, is there a way that companies, as they make these implementation decisions, to sort of assess their relative peer group, resources to tap into? I mean, where can companies look to try to get a feel for, you know, what's going on in their sector that might impact how they would handle issues like that?
Well, there are a ton of resources, and as I mentioned earlier, you might reach out to your auditor for research materials, your advisor, your consultant. You know, in reading the SAB 74 disclosures, some of the companies have said, hey, you know what, we're waiting on our industry peer groups to make a decision. And, you know, I wouldn't want to be in that bucket, because I don't know how quickly those peer groups are going to make final decisions. So that's, you know, that's a tough spot to be in. You know, in terms of materials, you know, if you call your auditor or consultant, you might, you know, talk through the principles related to the issue or potential solutions. You can also look at the SAB 74 disclosures of your peers. What are they identifying? And there are a lot of large and small firms that are putting out industry alerts, white papers, and holding industry-related webinars. There's several lengthy books by the firms and individuals, experts if you will, on the ASC 606 with tons of examples. One of the firms recently came out with a book about a month ago that's almost 1,000 pages long. There are lots of TRG issues and minutes all available on their website. You can go to the issues tracker to see if there's a similar issue to what you have. You can even watch the TRG meetings if you want. You might Google and do a YouTube search and find recorded webinars or white papers on your issues. You know, perhaps there's a similar issue in a related industry that you might try looking at.
Okay, great. Thank you. So moving on to the next major topic, and we have a polling question, but before we get there, Paul, I wanted to come back to you a little bit on, you know, what your thoughts on the repercussions for companies that maybe don't implement in time, or, you know, do you expect to see any penalties or any kind of regulatory action? I mean, any thoughts on, you know, how this might play out for the companies that just either don't get there or don't get there fully?
Well, if a company's not ready, or the auditor disagrees with management, or if there are problems with the Q1 review or any transition adjustments, a registrant may not be able to file their first quarter. The potential penalties or consequences, if you will, could be significant. If management is delinquent in its filings, this could violate debt covenants. Banks and debt holders might start calling. It could affect the issuer's business model, or even worse, the issuer could eventually be delisted. While all this is going on, management could get a call from the SEC staff to find out what's going on. To top it off, the issuer could end up as part of an SEC enforcement action. In September of last year, Andrew Cerezny, Director, Division of Enforcement of the United States Securities and Exchange Commission, gave a speech where he talked about recent enforcement cases related to audit failures. These included capacity and competence issues, undue reliance on management, essentially no audit at all, insufficient audit documentation, independence in evaluating management estimates. At the 2016 ASCPA conference, Mark Panucci, Deputy Chief Accountant of the United States Securities and Exchange Commission, talked about enforcement cases that included ICFR where warranted. One recent enforcement action, according to Mark, focused on an inadequate evaluation of the severity of an identified control deficiency. While an SEC enforcement action may be viewed as the worst case scenario, there are other significant consequences. The issuer could have a material weakness on its ICFR environment, an ineffective ICFR environment, if you will, or they could end up with restated financial statements down the road. If issuers have not trained their FP&A teams, their visibility and forecasting into the future could be cloudy, resulting in problems keeping investors and shareholders informed, which could potentially affect a company's stock value. Poor visibility in estimating future revenues could also impact fair value analysis, goodwill or long-lived asset impairment analysis, or any estimates that depend on estimating future cash flows. Poor systems, visibility, transparency, and aggressive judgments could result in incorrect conclusions related to variable consideration, and management may end up with significant reversals of revenue, which may also draw the eye of the SEC. Investors may also be concerned if earnings and revenues become choppy and less predictable because of reversals of revenue, again, potentially impacting stock value.
Okay, great. Thank you. Let's go then, Julia, let's go to that poll question and see if we can assess our audience about their biggest fears related to adoption. Again, this is a select all that apply. SEC inquiry, the audit process itself, financial statement accuracy, your boss or job, or something else. So let's go ahead. We'll take a minute to compile those results. And Tony, maybe just coming back to you, any thoughts? I mean, do you think companies are concerned about misses and whatever the repercussions might be, or, you know, it's sort of a secondary concern just based on trying to get through the adoption process as best as they can?
Well, I guess the first thing I wanted to say was that your one answer, which is my boss and job, that's probably going to be highly correlated with the number of people panicking in the previous poll. But we'll see if that happens. Yeah. I think people are correctly concerned about it. I don't think anybody really needs to panic or anything at all. But, you know, one of the comments that Paul just made, for example, about the FP&A, where he was talking about somebody from the SEC mentioning that, the ability to forecast, you know, is essential, because you need that to make internal management decisions. You need that to make capital resource allocation decisions. You know, for example, if you're a cloud computing company and you start offering different subscription models and so on, you need to know which ones you should be putting more money into. If you're an aerospace and defense company and you're providing certain kinds of services to your clients and potential clients, you need to know what the capital allocation issues are there. And many other forecasting issues. And I mean, you know, this issue of it being cloudy, et cetera, that's absolutely fundamental. I think that companies that make the decision to use the modified retrospective are potentially significantly hampering their ability to do forecasting. Because if you don't have enough information, see, for example, with the modified retrospective, you have the choice. You can either apply it to all your contracts at the initial that are open and incomplete, or, you know, you can rather all the contracts relative to only applying it to those that are open at that point in time and not applying it to some of the others. Some of the shortcuts and the cost reduction that the modified gives you is pretty expensive in terms of forecasting. And so CFOs, CEOs, the FP&A team, they need to be very, very much front and center when talking about which transition method to select. And I know this time is short, I know all those, but it's not as if once you're done with the implementation, it's all going to end. You have to keep applying this standard. You have to be leery of the fact that there's a cost standard to apply. There's a new standard on 610-20, which applies the revenue standards, recognition and measurement guidance to transactions that we don't apply it to today. For example, sales of real estate, sales of property, plant, and equipment. So when you look at the entire picture, the needs of the FP&A team, the needs of the management to be able to forecast these things is part and parcel of your decisions during implementation, but you need to make implementation decisions with an eye to the future.
Okay, great. Thank you, Tony. So results are in. We're displaying those. The biggest bars are, of course, the audit process and financial statement prep and or accuracy, which, go hand in hand. Shauna, curious then, you have any thoughts on this, any comments related to these concerns or others that you're hearing?
I mean, I think, again, it kind of depends where the companies are in the process and exactly what impacts it has to them. I think that this is pretty reasonable, what I would expect. As I said before, I think companies are definitely worried about getting second guessed, so they want to get the decisions made and ideally would like them audited immediately. Of course, the auditors aren't going to do that until they actually audit, and with some of the interpretations changing a little bit as they get more thoughtful, I do think that that's a challenge for companies. But as Tony said, not time to panic yet, but certainly time to focus.
Yeah, and just following up then, Shauna, back to you, related to Tony's comment on the, the adoption methodologies. I mean, what are you seeing and hearing? Does anything jump out that companies are sort of, grabbing onto that might help them make a decision? Any feedback thus far that you've seen in the market?
Well, some of that depends on the industry that they're in particularly, and then also there's a kind of an issue that came up regarding the S3 statements that might be filed in the year of adoption, and having to restate essentially an additional year if you were to apply the full retrospective method. So I think some companies are going with the modified retrospective for those reasons, but I would just say it's important to understand all the reasons behind why you would select one method or another, and certainly your advisor or your auditors might be able to help you through that. The modified retrospective, while it may seem like less work right now, certainly is going to be a lot of work in the year of adoption. You're essentially going to have two closes going on because of the extensive disclosure requirements and audit requirements. And certainly it's difficult to get through an audit, or not an audit, but a review in the quarters themselves. So it's going to be challenging. Providing those full annual disclosures in the first quarter of adoption are difficult as well. There's just a lot of stuff going on that is causing some time concerns for the companies.
Okay, great, perfect. Well, with our last couple minutes, I think what would be great to just go back through the panelists and maybe get, final thoughts, advice, whatever you'd like to highlight, suggest to our audience today. Paul, maybe I'll come to you first. Any final thoughts and nuggets that you might want to pass on that we haven't covered yet?
I guess if I try and fast forward and think about, okay, how are investors going to look at this? with so many companies that appear to be leaning towards the modified transition method, I guess I have concerns that the market might react, because, you know, revenue's one of the main line items that investors look at. And if there's no, you know, real visibility, or if it's cloudy, as Tony was saying, then, you know, the market could react and could penalize companies for using the modified transition method. So, you know, companies are going to have to explain to investors, you know, why are there differences in trends on each financial statement line item that changes. You know, these companies that are using the modified transition method, they're, as Shauna was saying, they're going to have to report under, you know, they're going to have to do dual reporting all of next year. So, you know, then, you know, fast forward a little bit more, if there are a few or a bunch, or, you know, I don't have a crystal ball, so I can't say how many, but, you know, if there are delinquent filings because companies aren't ready, then the market could react to that too. So I guess I'd be curious, or wish I had a crystal ball to see how the market would react to the implementation of 606.
Okay, great. Thank you, Paul. Tony, any final thoughts, pieces of advice?
Yes. One of the things that I emphasize in my work on 606, both the implementation and the consulting work that I'm doing, is that you need to have a core team that's working on the project of implementation. You need to support that core team with resources, and whoever you're working with should be imparting and actually, you know, transferring knowledge to that core team so that they can do a lot of this work as they go forward over time. And I also certainly agree with Paul with respect to the, that, you know, what the market consequences of using a modified retrospective will be, where you may have an inability or at least a difficulty in explaining trends. And forget about, you know, if you don't want to think about explaining them, just think about, if you don't have them internally, how you're going to run your business.
Yeah. Okay. Shauna, final thoughts?
Sure. I would say at this point, given the amount of time we have left, that it's really important to have a plan, time box the effort required, and figure out what needs to be done. Prioritize the things you can get done and need to get done to get that C or passing grade. I mean, nobody's going for an award for best revenue recognition implementation ever. But keep an eye out for the sustainability, as Tony mentioned, ongoing. So you don't want to cut corners and shoot yourself in the foot. So
okay, I think we might have lost you at the end there. I'd be remiss not to plug SOFTRAX a little bit here, so hopefully all of you attendees will come and visit us, visit our website, reach out to us. We'd love to speak with you about your challenges and see how we can support you. Julia, I'm going to pass it back to you. I know we're a minute or so over. Let's pass it back, and you can do our wrap.
Thanks, Jeff, and thank you, Shauna, Paul, and Tony for being a panelist today during our discussion. I do just want to quickly remind everyone that today's webinar, all attendees are eligible for CPE credit. We'll be sending out an evaluation survey after the webinar. And any questions regarding CPE credit, feel free to reach out to me at julia.sad@softrax.com. And here is just in general the SOFTRAX contact information. If you have any specific product questions, feel free to reach out to us. And that is all we have today. We hope you enjoyed today's webinar and hope to see you again in the future.
Yep. Thanks, everybody.
Thank you.
Thank you.
Thank you.